Hey guys, this is Israel from the Israel Keys Wealth Academy. This is Saturday, the 8th of February, and this is an analysis / teaching session. But today I want to focus on a concept. Now, we've just started the Market Breakers course for those of you who are in it, and we are building from the ground up. But we are aware that there's some of you who've been trading for years who some of the basics we're teaching at the moment may not necessarily seem to be that applicable. We're asking you to please sit through them. In my opinion, one of the reasons why many traders fail is what I call gaps in their understanding of the foundations. And so we're insisting everybody goes through the basics because we want to make sure that when we start to build, especially when it comes to the framework of the methodology of how we approach the markets, because some of the things we'll be teaching further down the line will not make sense or will be cause difficulty struggling with if you don't understand the base foundational methodology by which the markets move. And what we're trying to do to counterbalance that is from the beginning in some of these teaching and analysis sessions, we're dealing with advanced concepts straight out the gate. Now, if you're a new trader, these are being recorded. You can come back to them when some of the concepts have been taught foundationally. But we want our more experienced traders to start to have something they can use and apply right away. And so this is a chart of the euro dollar, the euro, as of Saturday, the 8th of February, 2020. And I want to show you something real interesting here. Now, as usual, we scream this from the mountaintops. Please get those indicators, fancy indicators off your chart. First of all, any indicator that exists in a window beneath the chart, 99.9% of them don't make sense. Throw them away. Your MACDs, your RSIs, throw them away. Secondly, moving averages and all those things, while they may help you in the big, large picture, especially with establishing a trend and stuff of that nature, they just clutter up your chart and take your eyes away from price action most of the time. This is how price moves. Now, I want to draw your attention to the orange boxes. Now, this is a 4-hour time frame. But this principle works on any time frame. I've chosen the 4-hour because the vast majority of people in the Wealth Academy are either intraday or intra-week traders. We have a few swing traders, but I don't think anybody trades position just yet. And if you are a position trader, please still watch this because this applies on all the time frames. I just chose the 4-hour because it's, in my opinion, the intermediate time frame that the vast majority of all traders refer to at some point or the other. It will also work if you're scalping the 1 or 5 minute time frames, but this is how it works. Now, last week we dealt with the daily bias, the daily engulfing pattern. And just to remind you, it's the fact that let's just go to a daily chart real quick just to cap that off again. If you look at a daily chart in almost any currency pair, you will see a powerful pattern where every time, just ignore my my annotations on the chart. I was doing something for a student of mine, a private student of mine. If you look, every time there is a daily engulfing reversal, and the breakdown of this is simply where a daily range in one direction is taken out the other way. This, for instance, candle right here doesn't look necessarily like an engulfing. It's just a sharp reverse on the same candle. But if you drill further down into an intraday chart on that time frame, let's find that date, you'll see that the principle is the same. And this is the principle. Let's just find it. Oh boy, that's why this is going on. Sorry, guys. Okay, yeah, this should work now. Keep snapping us back because we had the snap. There we go. So there's that day. Let's see what happens. Now, these are some of the things that I didn't talk about in the free season because I wanted to make sense when you pay for it, to have some meaning. There's no point giving it all away for free than asking you to pay for it. So that's the day. So this is the day in question. So I'm going to take this, just to delineate that one day on the 1-hour chart. Now, if you are a new student to trading, this might not make sense. Just watch it, keep it in your memory bank, and come back to it when we teach the actual concepts that we're applying here. Now, as you can see, this is what's gone on. The day opened here and went down in the first half of the day. And then that same day, so that's the first half of the day. In that same day, there was a reversal of the daily range in that one day that took out the daily range from the previous day. So there we are. That was the previous day. That was the high of the previous day on a down day. And as you can see, in one day, usually this happens over 2 days, which is where we see the engulfing pattern. But in one day, that took that out completely. That's what I refer to. I know it's not the classical candle engulfing pattern, but that's what I refer to as a daily engulfing. Now, if this day itself had had a significant swing high, it could have happened just in one day. In essence, we're looking at a day in which the last significant swing high on a 1 hour chart or below, but a 1 hour chart is usually a good barometer, is taken out. And so whether it happens as a classical engulfing pattern, in which case you need 2 candles, or it happens in just one big massive candle one day, in essence, a candle that goes deep down one day. For instance, if this candle had opened up here, gone all this way down, and then closed back up here, that would have been good enough for me. Now, as you can see, whenever that pattern happens, usually you get a run in price, at least for a few days. And so at Israel Keys Wealth Academy, we advise that you don't trade anything less than a 4 hour chart in the opposite direction of a daily engulfing, and even the 4 hour chart as well. So see here, when we had this daily engulfing here, we would have been bearish all the way down till the next engulfing, which would have been here. So we'd have gotten out somewhere around here this day, maybe gone north, but because we knew the general weekly trend was down, we'd have waited till the next daily engulfing the other way and then rode it back down again. And so if you synchronize your weekly engulfings and your daily engulfings, use the weekly engulfing to set a long-term price direction. This is in the trending market, and a daily engulfing as a daily bias. You will find out that most of the time you're on the right side of the money. So that was last week. Now let's go back to this week. So we're in a 4 hour chart now. And I taught this without showing you this in principle in the free sessions. But let's get a lot deeper into it now. So the market has certain phases you need to understand. And another reason why traders don't make money is they don't understand market phases. And the rules of the game in each phase are different, or profiles. Some people call them profiles. Now, there is everything starts with a contraction profile or contraction phase. Now, in a contraction, price is bunched up together and is ranging. Actually, this box, let's leave it there. Price is boxed and is ranging within a specific range of price. Now, what's the range? It depends on the market, on the time frame you're working with. So, for instance, on a 4 hour chart, 24, 25 pips is a range. On a 5-minute chart, that could be a trend. But pictorially, and this is why charts work well, this is why technical analysis works so well. When you see price begin to move sideways in a period of time, meaning it's going up and down within a defined range and refusing to break out of it, like here, this is literally the beginning of the market in that time frame. And I'm going to show you this. Let's look at this on other time frames. Let's look at this on other time frames. Let me put this on a 1 hour time frame. So let's put EU on a 1 hour time. Let's use a 15-minute. Now, this period dividers mark periods. So on the 15-minute chart, on a 1 hour chart, and below they mark days. On a 4-hour chart, like we saw here, they mark weeks. On a daily chart, they mark months. On a weekly and a monthly, they mark years. And so the temptation is to see the day or week you are trading, whatever period of time you're trading, the temptation is to see it as starting when this line begins. And sometimes that is true. In my opinion, it starts when you have the beginning and the end of a contraction. Now, on 15 1-hour charts, this makes sense because usually these contractions, as you can see, and I've actually delineated them with a box, they usually happen at the start of the day. Almost always they'll happen at the start of the day. Sometimes they don't, which is when we get in trouble. On a 4-hour chart, they usually happen at the end and the start of the day. You see the end and the start of the day. So there's usually one to end the day and another one to start a day. If you take both of them together, and you can get one big box. The same with the week. As you can see, usually at the start of the week, but with the week, sometimes it happens in the middle. Now, let's go to a daily chart. Today. Let's go to a daily chart. Again, you see that with the daily chart, they usually will happen at the start or the end of a month. This is why we tell you, be careful with Mondays on the week. Be careful with Asia session during the day. Be careful with the months. And even if you look at a weekly chart, they usually happen again at the start and the end of a year. That's why I usually, if I want to take a break from trading, it's usually January or December. And think about this from the perspective we've taught you to trade. It's human psychology. It's a new week. It's a new day. It's a new month. Traders want to see what's going on. But the market makers are using this contraction phase to feel out the market. We call this the accumulation of orders. And so they're holding the market intentionally in a tight range. And on a daily chart, you will notice this. If you look at the charts between roughly 8 p.m. to midnight UK time, the spreads are stupid, usually about 9, 10 p.m. Where the EU might have been 1 pip, it's now 5, 6. It's intentional because they don't want you in the market at that time. Or if you're in, they want to trap you in, is what I should say. They want to trap you in so it doesn't make sense to liquidate your position. And they're building orders both ways. They're making up their minds what pockets of liquidity to go for. And then even when they then reduce those spreads, they will still hold the ranges in tight, or the price in tight ranges, because they want to see where retail and even other market maker sentiment is. That's the contraction phase. You don't want to be trading in the contraction phase on that time frame. Now, what's a contraction on one time frame could be a trending phase we're going to see now on another time frame, because if, for instance, if you drill down in this chart into 15 minutes, let's see. So you could have traded here, even though it wasn't a box. If you, for instance, if you traded this reaction at this point, you'd entered here. If you had a 10 pip stop loss, you would have had a 20 pip profit. Should you have traded it? No. Could it have made you money? Yes. And of course, in here as well, if you'd gotten in the box here, that would have been a 9, 10 pip stop loss. You could have ridden it out of the box for. So I'm not saying don't trade in the contraction phase. I'm saying don't trade on the time frame it's contracting. So if it's contracted on that time frame, the only way you can get a decent trade, in my opinion, is to find an entry on a much lower time frame. But what it tells you is that period in the market maker's mind is about to begin. Because usually out of a contraction box, there will be an expansion. That's the second phase. And usually price will first expand, not always, but it usually will first expand in the opposite direction of the real move. 70% of the time, the first move here, this is quite simple because this happens immediately. So price contracts there. It leaves the box here, comes back in, and then goes south. Here is a contraction. It leaves the box, goes first north, and then comes south. This is an example in which it just goes the same direction. And as you can see, it's going the same direction here because it's referring to a price from a previous contraction box. But I'll show you all that later. That's actually this line is not where it should be. That's actually one of the tricks that we're going to show with this video. So we put that there. Yeah, that's the middle there. And you see the middle of that box lines up perfectly with the middle of this one here. And so the reason why this box runs away straight away is it's what I would call a referred contraction, because the first contraction was here. You see there was a contraction here. Price went south. It came up, fell short of its target, came back down to the middle of that. And you got to look at the middle of those contraction boxes. That's what we call fair price or average price in the market. And you need to understand that to really be consistent trading in the long term. But that's not going to be something I dive into today, probably next week or next session. And so because they converge, it doesn't need to come back there because it's there because it's come back already to that box's mean price. You see, first of all, it contracted, right? There was a spike here, then it really went down where it wanted to go. Came, found support there, rallied. The rally failed, came back, found support at that line again. And as you can see, it took out that zone of liquidity. Remember, liquidity zones. And then it picked up the orders it really wanted, and then it ran. And you need to be able to spot, see here, contraction down the other way, actually comes down to meet this contraction from here. So when they start to layer on each other, it's a thing of beauty. So it comes down to that one there, picks it up, picks up some orders in that liquidity profile, runs, comes back down into this box's profile. Again, this is what you would call a pullback. So you think that this is just a pullback on a trend. Okay, this is an entry opportunity. But now you're seeing what's really happening at a molecular level. And then it goes up. Where does it go up to? Back to the mean or the average price of these two boxes side by side there. It stalls and then starts coming back down. On its way back down, it blows through this mean price. It comes back up and touches it to the pip and comes again. And as you can see, contraction, expansion, or should I say manipulation? So CM, contraction, manipulation, expansion, retracement, follow through. CMER. The market first contracts in a range. 70% of the time will manipulate by moving in the opposite direction out of that contraction range. And the few times where it doesn't, most of the time it doesn't. In those few times it doesn't, most of the few times it doesn't, it's because it's already coming back to a previous contraction. Then it expands in the direction that price is trending in. There is a retracement and then the full follow through to its target. So CMERT or F, follow through, or T for target. Contraction, manipulation, expansion, retracement, target. Now, the targets are out of the range of this video because that involves you understanding liquidity profiles, which I'm hoping to teach to the new students soon. But those of you who've been with me in the free section already understand liquidity profiles. In essence, pockets of liquidity in the marketplace that you can see on a chart. And usually the targets will be liquidity profiles on that time frame or a higher time frame. But I need you to be able to spot this. If you can spot this, you're halfway there. In essence, when you see the market contracting on any time frame, That's the beginning of the period. That's the real beginning of the day. One of my mentors calls this the true day. It's the real beginning of the day or the week or the month. Forget the dividing lines and MetaTrader. Those just help you see periods to a degree. But the action really begins when you see a contraction. And so when other traders are leaving the markets thinking, well, it's contracting, it's boring, that's what retail dumb money traders do. Institutional traders and smart money traders like us will say, this is the time to stare at my charts, especially if you're on a lower time frame, because something's about to happen. This is what happens on the daily strategy that I taught some of you in the free section. As you can see, there's a contraction usually overnight coming into the early morning London period. So this is a 15-minute depiction of what we just saw on a 14-minute chart. There is a manipulation the wrong way, an expansion the right way, a retracement, and a follow through to its target. It happens on a daily chart. Let's use this. So let me give you an example on a daily chart. So part of the day. Okay, so there is an example. These are now, the higher up you're going in the charts, the harder they are to spot, but you can still see them if you know what you're looking for. Now, the boxes don't have to be perfect. For instance, while this was consolidated, it dipped out the box and came back. Just ignore that. We're not saying it has to be perfect, but you can see that for a few days, price is being held in a range. Let's start it. Let me fix that. That really should start here. There we go. So for a few days, price has been held in a range. And then it expands significantly out of the range. But that's a manipulation. So that's a manipulation. Then it expands in the right direction. It retraces, and then it follows through. In this case, the follow through was just not too far from the original retracement. The opposite happens here. Again, ignore these spikes. So now sometimes it can double whip, especially on the higher time frames. It can fake you out both ways. So that's why you got to be patient to see what the real manipulation is. So you see, if it depends on where you drew your box, but that's how I looked on my box. It just dipped out there, ignore that, came back into the box. Then it expanded, manipulated this way, expanded that way. So it manipulated this way, expanded that way, retraced, and then back to its original direction. And as always, you always want to figure out what that's not for this week, but just keep that in your mind. What's the average price of the contraction phase? It will usually, and this is how you do it, so you don't guess. Just take a Fibonacci, draw from the top to the bottom of the box you drew, if you drew the box correctly, and stick a line. Let's delete that. Stick a horizontal line on the 50 fib of that box. So that's 178.6150, the 50 fib of that box. And then take the Fibonacci away. And look at the magic. See, this is actually better than I could have hoped for to show you. I didn't have to plan this. See how price touches that to the pip. Now, sometimes it'll wick through it or be just above or just beneath. But so when you see some of my magic lines on my chart, I'm just showing you this is how I get them. Again, let's do that here. And this is on the daily chart. So you wouldn't expect the level of refinement as you would on a lower chart, but it still works. So let's find 50. That's 176,150. There is 50. Then you take the fib away. And what do you know? Price. Look at what price does at that point. And it's coming back down. And then when it let's take this away. When it retraces, you see how it respects that level. Because in essence, if that is a valid move in that direction, the market makers don't want to take the price or keep the price beyond that point. That's the average price. That's the fair price. That's the market value in that moment. And so they want to drive it. If they're selling, they want to keep the price below that price. If they are buying, they want to, if the price, so I take that back. If they're going to buy, they want to keep the price below that point. And so they're going to drive the market down to a point at which they feel it's cheap enough for them to then buy and reverse it. On the flip side, if they're selling, they want to keep the price above that price so that they can sell at the highest possible point. And so they're going to be incentivized to push the market in the opposite direction based on what that average price is, until, wait for it, they have a new average price, in which case that then becomes a new reference point. But as we see several times, those old contraction boxes, as we saw here on the, let's see, are still valid way into the future, because someone with deep pockets still, who didn't jump in here to reset the market here, still has an interest in defending that level. So when you put this in charts, I showed you how to put the liquidity lines, so that's the highs and the lows, but you also need to learn to put the these fair market value prices as well, because the boxes and the levels, because they're going to be respected perfectly. So let me show you something I've been skipping through real quick. So what I've done is just to test out my theory, well, test out not my theory. I went and I paid a significant amount of money, far more money than most of you and any of you are paying monthly for the mentorship. So literally just to get this, it's a software from some people out there. They don't teach you to trade. They just develop the software and teach you how to use it. But the reason why I signed up for it, and I'm paying almost $200 a month for this, is it does the work for me. Now, I am planning to design my own or our own software, Israel Keys Wealth Academy, but I wanted to see what it would do to help me out. And so when I was institutionally trading, when I was trading, thousands on per trade for the fund I was working for, I invested my own money in something doing this for me. So rather than drawing the boxes myself, what this software does is it draws them for me. It gives me the box, what it thinks is the box. Many times I disagree with it, but it just draws my attention to the fact that the box is forming there. I then need to go in and refine the box myself. And I've only used this for about a month, and I've stopped using it now because I just wanted to see what it would look like automatedly if it was possible. Because Tucker and I were planning to design some of our own auto trading software, and I thought to see what was out there. But I like these guys. I tried a few. I like theirs best because it draws the liquidity lines for you. So that line there, in essence, highs and lows, previous highs and lows. So a green line is a previous low. A red line is a previous high, because you expect the market to respect those if it's going to turn. It also draws the contraction phases out for you. And then it draws the mean price of that phase. Sometimes it'll draw the mean price without a box, because their software, that's how their software works. But this just shows you what it looks like. And I wanted to show it to you so you can see what it would look like if you sat down and drew it all out yourself. Come on. I'm trying to show this on the lower chart. Okay, there we go. So as you could, so that's it on the lower chart. So you see box. Well, in this case, Daydream up here and drew that box a bit too high, but there you go. That's the mean price. It goes above the mean price, finds support near liquidity line. In this case, it was a previous mean price line, then it shorts. This is a classic London strategy. The box forms overnight. You wake up in the morning, it rallies out the box, manipulates the wrong way. It runs into this liquidity level there, and then it comes back down and goes the way it wants to go. It retraces back to another liquidity profile, and then it runs the right way. So just ignore this. Like I said, this is someone's software I'm testing to see if it will help me not have to do all the manual work of putting it on. I'm not really convinced by it because one, the way the boxes are drawn, and secondly, it misses out some of the levels, but it's the best I found. But back to this, you can do it yourself. And especially if you're not trading, if you're not scalping, meaning you're only taking 2 or 3 trades a week, by all means, please do it yourself so you can actually refine it yourself. But that's what it looks like when you do it yourself. And it's, in my opinion, absolutely perfect. And this is how I've been trading now for a few years. This is how I put up some of the trades last year that were to the pip. Because as you can see, if I gave you this signal, it would be to the pip. If I entered here, it would be to the pip. Now, you don't always get it to the pip. That's why you have stop losses and spread, or taking into account the spread and things of that nature. But this is how the markets really work. They contract, they manipulate, they expand, they retrace, and then they follow through to their intended target, at which point there is a reset sometimes with a new contraction phase, and then we go again. And sometimes you'll have multiple contraction phases in one run-up because they're trying to build, they need to contract several times to build the momentum in the direction they want to go. I'll leave that there for today. See you guys next week. Bye-bye.